Hi everybody, this is Jose Blasco. We are about to get started. As always, quick sound check. I would really appreciate if you could have a quick message on the chat box just to say hello. That would basically confirm that you hear my voice, and then I will know sound is ready to get started. So we start on time as every day. So please go ahead and do that. Quick hello on the chat box if that's okay. And in the meantime, I will turn on my video stream on my end. Here we go. How are you, my friends? Good to see you. I'll be here in the bottom right corner of the screen, so we have most of the space available for the charts. But at least that way we are a bit connected, if you wish, as we, at least you see me. Here we go. We just hit the top of the hour, so it's time to get started. So we are live, my friends. How are you, Maka, Ahmed, everyone? Good to see you all. Wonderful, wonderful. Just checking everything. Very good. Perfect. Well, let's begin. March 17, 2021. Welcome to the session Options with Options. Options gives us options. I love it, love it, love it. Probably you love it too, isn't it? So we're going to be looking at the markets, looking to identify different trading opportunities and, just execute those trades. And of course, while we are running the session, it'll be a little bit of a mix as I will be mixing some lecture time with some trading time, depending on what the market is providing us as we are taking options to the next level one step at a time. Okay. Disclaimer before we begin: make sure you read it carefully. It's just a couple of paragraphs. Don't skip it. Read every word, please. This is important stuff, important information. Risk involves money. Trading involves money. Therefore, there is risk involved. So make sure you read the disclaimer, guys. Agenda. We started with a quick hello. I want to also remind you all that we are simulcasting, which that implies multiple things. Number one, some of you are attending the session using our website, tradewithufos.com/live. Those are our coaching plan members, okay, which are subscribed to the coaching and therefore have access to full duration sessions. And then you have other places such as YouTube, Facebook, and so on, where we are simulcasting the same sessions, but they are shorter duration, and therefore they are more suitable, if you wish, for the traders that you are looking at trading, like, let's call it part-time, for example, or you are still serious about trading, but maybe just a bit less serious. And in this sense, that's good enough for you, okay? But for the ones of you that want more, well, typically what you guys do is to join our coaching plans, which also, if you were to select the yearly membership, you also get a course for free once a year and things like that. Okay, so take a look at our website. There's plenty of detail. I don't want to spend much time on this now, but make sure you are well informed so you understand how to use the tools. Okay, and again, the plan for the session, very similar to almost every day, will be to look at the market, review the trades that we have, talk about trade management if any comment needs to be made, and from there start researching for market opportunities. Okay, very good. Siderman, how are you, my friend? It's good to see you all. Very nice. Okay, so time to jump on the charts. Let's begin. Here's our beautiful TradeStation. So what's going on today? Well, the market is down by 0.58% as we speak, as I froze the screen. Again, this is the S&P 500 ETF. Other markets could be the Dow, could be the Nasdaq, could be down even a bit more, a bit less, whatever. The S&P certainly is a great measure of what's really truly happening across the most relevant stocks in the market, isn't it? Together with the S&P, we have the VIX. Okay, and I want to come back to the S&P in a second, but I want you to see that as the market is falling, okay, so what's happening to the VIX? So the VIX is increasing by 5% today. So we are talking about values of around 20.82. Okay, and these, by the way, I'll talk about our trades in a minute. The last session, I believe it was, we put together a calendar spread on Philip Morris. And this rise of volatility that we've seen in recent times may be helping that trade. We will take a look and evaluate that in a second. Okay, cool. Going back to the S&P ETF. Okay, going back to the S&P ETF. So what do we have? Again, from a climate point of view, let me zoom in. So we are in an unconfirmed climate just like a few days before, and then it confirmed, and now it's back to be unconfirmed. So again, it's a tricky situation. And again, why is that? Well, probably we are candle number 6 out of what a normal climate would be 9. So there may be people thinking the market is making all times high again, let's take profits. So again, a little bit of a battle. Then on the other hand, a few days ago, price came into that UFO and started bouncing up. Probably, people took advantage of this little drop there to, reinvest or add more to their positions. And we saw that with the UFO and so on. So a little bit of a battle where we may have serious collection of buyers as well as a serious collection of sellers, and this is what normally brings the climate to not to be confirmed. When it's clear that you got more buyers than sellers or more sellers than buyers, typically the climates would be confirmed, but it's not the case. Okay, so again, as always, a good idea to have a diversified portfolio. We'll need to talk about that more in depth as well. I mean, we've talked about diversified portfolios all the time, but from a directional point of view, I would say you want to make sure you always have positions to the long and the short side. Don't ever always be long or always be short, because that would, create trouble. I mean, if you were to trade markets like futures, currencies, forex, commodities, then yeah, I mean, crude oil is crude oil, gold is gold. The S&P futures is the S&P futures, so you go either long or short. But if you are trading stocks or options on stocks, you better have a bunch of trades betting on up movements and a bunch of trades betting on down movements. So if something major happened against some of your trades, other trades are offsetting the problem, bringing in some profits. Okay, so that's the concept of being hedged, if you wish. Now, the beauty of options, okay, and the reason why I'm saying all of this, which some of you may know very well, you may be thinking, why is Jose explaining this? This is very obvious to me. Well, the reason why I'm saying it is because, number one, it may not be obvious to everybody. And number two, because while when you trade stocks, the only way to be diversified is to be long and short some positions and try to have a hedge portfolio. With options, the beauty is that we could achieve that goal of being diversified in other ways. Okay, we could achieve that goal in other ways. For example, through the use of different option strategies. Okay, and this is exactly, and that's making this comment leaning into Facebook and Philip Morris, where Facebook was a trade that we put together that was non-directional. Okay, a non-directional trade, which again the one, this one I'm just gonna delete this one. Okay, so the box on the left. Okay, that trade that we started in February. Actually, I just made a mistake. It's next Friday. I just got confused with the lines. So let me replace 204. Sorry for that, guys. I'm just probably confusing you. I just got confused with the lines. Let me go back here. So from here to here. Here we go. So now I have it the same way I had it before. Here we go. So we have two trades here. One with Facebook that was started on February 4 with expiration date being 19 of March, which is 2 days from now. Notice how Facebook is right here. As we speak, we just need Facebook to remain in the purple area, from now until that expiration date on March 9, which is almost there. If you were to look at probabilities, just click in the wrong place. I need apps. Here we go. So OptionStation Pro. So if we were to look at probabilities, okay, the last time we did the math, we saw the inner range to shrink. Then we were doing the trade for a further expiration date, and we had another set of dotted lines, which I'm gonna show you in a second. So Facebook, FB, here we go. Here we go. So you see we got two expiration dates, two trades. One is an Iron Condor with March 19. The other one is an Iron Condor with April 16. Okay, so those are two different trades. Okay, so if I was to select March 19, so what probability suggests is that price will trade between 269 and 289. Okay, 269 to 289. So if I was to get two lines, and because those are expiring sooner, I'm going to use a different color. So I will use, for example, I'm just going to use the magenta color. So 269 is somewhere here, right? And 289 is somewhere there. So in other words, from now until that next vertical line, which represents March 19, so that stock should remain between those values. And if it tries to go away, we got UFOs above and below to defend ourselves. So again, this trade is looking very, very good, unless something very, very crazy or very powerful happens to Facebook. Really, this trade, it's very close to, almost a sure thing profit based on probabilities. I mean, there's no such a thing as a sure thing profit in trading, but based on probabilities, you can see that, the range is way wider. It's like double the size of what probability would suggest. Okay, so we should have a good ending for this trade. We will look at it again tomorrow, and certainly next week we will reconfirm that what happened, because tomorrow is still Thursday. But it's looking good. And then we have another trade with the outer range, which was 296 to 37. Okay, and again we are in the same situation with again a pretty wide range and and stuff. Even though this one has a further expiration date, which is April 16. Okay, so right before clicking on Facebook and going over reviewing this trade, the comment I was making is, with options you could be diversified thanks to the use of different option strategies. So the point on Facebook is that we are betting on that stock to remain range bound, or maybe not so range bound, because short term it's actually trending, isn't it? But as long as it stays within the purple area, so then we profit. That's what we call a non-directional trade, right? Well, but guess what? With Philip Morris, we also have a similar setup where we are expecting that stock to, to trade within a range, okay, from 101 to 73. Okay, it's also the same concept of being non-directional, but the difference is that with Philip Morris, we are using a calendar spread, which is a strategy made of buy a call and sell a call, or buy a put and sell a put. And if I'm not mistaken, we were using puts. Okay, let me take a look. We can look at this here much better. Okay, so here is Philip Morris, and you can see that we sold the 87 put and we bought the 87 put using March and April expiration. Okay, you can see that here, isn't it? So 9 days to go with the one we sold, 37 days to go with the one we bought. Okay, so we are in the middle of the trade right now. As you can see, this trade is providing -$4 of P&L right now. So right now, not much is happening for the trade. We're still, in that waiting stage. But again, what's the beauty of this is that we are in both cases exploiting a non-directional strategy, which by definition is typically a higher probability of success compared to directional strategies. Okay, why is that? Well, because having the stock move for a long time in the same direction all the way to reaching a target, it's normally less likely than having the stock maybe have some directional component but go up and down. So even when the stocks go directional, for example, here it went down but you got many movements to the upside, right? Or here it went up, but while it was going up you had many movements to the downside, isn't it? So in other words, if you were to look at this big picture, that's you could call that a sideways market, if you're depending on the time frames you observe it. So again, we are in a situation where we don't really care where price goes as long as it stays within a range. In this case, 101 to 73, and we will likely profit from that. But while we are in that same non-directional situation, the Philip Morris trade is a trade where we were buying options, paying for it, and we profit from either an increase of volatility, the VIX and the implied volatility of the stock itself going up, or if volatility was not to rise, when the options that expire in 9 days expire, then we'll sell another 87 put, and then another 87 put, and then another one, and we'll just keep doing it. Okay, so that would be how we would profit. While with Facebook, the strategy we're using is actually a strategy with 4 options, where here what we did is we created a credit when we created this trade it created a credit, and therefore here we're not going to do additional adjustments unless we get into damage control mode, which we'll need to learn about that. How are you, Joan? But with this trade, we are basically waiting for time to pass because what we did was to sell pricey options that had hefty premiums built in, and therefore we were sellers of the options on the case of Facebook, where we were mainly buyers of options on Philip Morris. And when I say buyers or sellers, I'm talking about the net effect of your trades, because in both cases, we have options that we purchase with a plus sign, and in both cases, we have options that we sold with a minus sign. But the net effect was a debit on Philip Morris, so we were paying for it, and the net effect was a credit on Facebook. We were net sellers, even though it was a combination of buy and sell options. Okay, so again, all of these, for the ones of you that have been trading options for a while, is probably very clear, crystal clear. For the ones of you that you are exposed to options for less time, hopefully this little kind of review is useful and healthy. Let's take a look at what's going on with the volatility of those stocks. So if I look at Philip Morris first, and I enable implied volatility stochastics, I mean, that value of 2.71, that's not the implied volatility, okay? It's just an indicator on tradestation, which I do appreciate. But if you wanted to find out the implied volatility, what you will want to do is to just look at implied volatility all options right here. And when you click OK, it will tell you that the implied volatility for that stock is 21%. Okay, that's the implied volatility. If you were to look at Facebook, okay, so instead of 21%, okay, we are dealing with 32%. Okay, so you can see it's a different stock with a different nature, different expectation. So remember that implied volatility values, in case you don't know, they basically represent the annualized expected move based on the options pricing models. So an annualized expected move of 21% is expected on Philip Morris, where an annualized expected move of 33% is expected in the case of Facebook. This is an extrapolation out of, let's call it, running a reverse engineer process once you see the prices of the options, okay? Because the options are priced based on multiple factors, where if you look at the price of the option and you know all the other factors and you extrapolate, you kind of reverse engineer the pricing model, so now you get the expected move, okay? Anyway, I wanted to clarify all of this because while I'm very aware that to many of you this is, again, one more time, crystal clear, I will be adding more and more and more option strategies as we go, and I will often, or probably almost always, refer to the fact that so this trade is a trade that we are doing, and we are in a scenario where we are debit trading. This trade is a trade that we are doing, and we are in a scenario where we are credit trading. Options are pricey here, options are cheaper there, etc., etc., etc. And while I will be bringing in more and more analytical tools for our options trading, right now I'm running the scanners, okay? And if you were to customize the scanner that we use, for example, here for non-directional trading, notice that there is one parameter, which is precisely that implied volatility stocks, okay? When I'm using at an IV percentile, and percent, not percentile, that was wrong. And basically, I'm either working on the bottom 50 or the top 50, meaning, the bottom 50 cheapest options out there in the market that meet our other rules, or the top 50 options that are the most expensive ones that meet our other rules. Okay, so again, trying to stack odds in my favor this way before I even load the charts. Okay, good. Wow, that was a long one, but that was, I believe, a needed recap, as also based on some of the questions that we have received in our support team in recent times. Okay, so hopefully this is good stuff. Time to trade, my friends. Okay, and since we started putting trades together, focusing on the non-directional ones, we had Iron Condor with Facebook and the calendar spread with Philip Morris. So, and you have just seen my customized filter here where I'm pointing at bottom. Okay, so again, my scanner, when I run it today, earlier in the day, that scanner is looking for stocks that are trading range bound and that has cheap options or non or underpriced options, if I want to be a bit more technical, operatically correct. Okay, so we'll start with UNH and see what we have there and evaluate if there is any possibility for us to take a trade. So again, always important to be aware of the next earning dates. No matter if you're gonna be buying or selling options, that's critical. You'll see as we build the option strategy. And then the other thing that is critical to know, it's about the probabilities. If you do an non-directional trade and your probabilities are less than 48%, so the rule that I am using means that I simply pass on the trade if its probability is less than 48%. Why? Because again, experience and also my conservative approach to trading implies that I consider not having enough odds. Of course, that's my decision. You guys can be maybe more conservative than me, maybe less conservative than me. Maybe some of you accept 46%, maybe some of you demand more than 50% every time. Again, there is no right or wrong. Just have a rule and just follow the rule. So my rule is 48% or more for non-directional trading, 50% or more for directional trades. That's my rule. That's simple. Okay. Siderman, what are the inputs for implied volatility or options? There is actually no inputs. Okay. So if you look at UNH and I re-enable implied volatility of options, okay, I mean, there is a moving average, okay, but I'm ignoring it. Okay. So if you look at the inputs, sorry, I didn't click on the right place. Here we go. So the inputs are the average length, which it's the moving average, okay, which is the red line. Again, I'm completely ignoring it. Okay, I'm not paying attention at all. Actually, you can make it one, and therefore the two lines would coincide perfectly. So that's the value that I'm looking for. This is the implied volatility, and this is taken out of the options chain, if you wish. Okay, this is kind of like the VIX calculation, which is looking at multiple strikes above and below at the money, applying a weighting based on delta, and basically it calculates that average weighted volatility across multiple expiration dates and multiple strikes, okay, with that delta weighting. And TradeStation calculates that at the end of the day every day. Other platforms report that value real time. I mean, it's not that critical to look at it every day. It's nice to have, but really what's important is make sure that, if options are up here, you are not buying them because you are really, paying something that is absolutely completely overpriced. Okay. So now if you are doing here, so you are buying something that is underpriced, and that's what we're looking for. Okay. So again, no specific settings, Siderman. That was the long story short. Okay. Or the long story long. So anyway, so 52%, that's what we have. That's more than 48. Okay, so that's good. But again, what's the concern? Look, if I look at monthly timeframes, so that stock is making all-time high. So when I go down to the 55-minute time frame, notice I only find one UFO, and that would not meet my rules for non-directional trades because I need at least two. Okay, two above and two below. So what can I do? I got one last shot, which is to check pre and post market data to see if I got 48% or more. And unfortunately, I only got 42%. And even if I had more, to be honest, I only have one UFO above price, one red UFO, which is not enough. We just said we need at least two. So what do? No issue. We move to the next stock, which is Honeywell. Siderman, if it's not working, it means that you may not be using a daily time frame. You may have noticed that every time I wanted to see the value, I switched to the daily time frame. That indicator, and that by the way is very common of many platforms. When you plot implied volatility, it requires you to be using a daily time frame, okay, daily or weekly or monthly, but no intraday. Okay, so maybe that was your issue. Take a look. So with Honeywell, 36% is what we get with pre and post market. So ignore. Regular session is giving us 51%. That's good stuff. Ready to go. Concern, only one red UFO. Is it another case of making all-time high, which by the way, it's a normal thing since the S&P it's kind of making all times high, isn't it? So yes, it is. You can see here this is the highest price, and it's not showing anything right above, only one red UFO, which is not enough. So we move to UNP and we do the same assessment. So here we got 3 UFOs, more than 50%. So all of this is good. What if I move to pre and post market? We have 41%, so that's not acceptable. Okay, so that's not acceptable. So let's take a look at that one. Earnings with UNP are happening on 422. Okay, 422, which is, let's call it a month from now. So we could certainly plan on utilizing that specific expiration date. Why? Well, I'm not fully sure yet. I would expect it, but let me confirm that with the option chain. UNP, here we go. So when looking at UNP, and I look at the option chain, so I got multiple expiration dates, and I can see 29, 24, 24, 23, 23, 28. Okay, so 28 seems to be a more expensive one. Earnings are happening on April 22nd and 23 of April. That's where the earnings are built in, and that's the one providing the greatest amount of implied volatility. Okay, so not ideal because like the last trade we did in the last session we had, which was a calendar spread on Philip Morris. In case you were guessing, so what I'm trying to do here, since that stock has options which are underpriced, I was going to either buy a call and sell a call using 2 different expiration dates, or buy a put and sell a put using 2 different expiration dates, which is again a calendar spread, time spread, or horizontal spread is the same thing. And I was going to do that, but what's my issue? My issue is that there is extra, maybe I'm a bit late to the party, earnings are just a bit too close on UNP, but that call I would buy has a little bit too much, okay, a little bit too much of implied volatility built in, and therefore I'm going to pay a bit too much. Okay, and that, by the way, is also, when you look at the spreads, options on that particular stock don't seem to be that liquid, isn't it? That liquid. So definitely no need to put time into this trade, because it doesn't look like it would end up in the place we need. Okay, so I'm going to check UPS. UPS with earnings on the 27th of April. Many UFOs above and below, great probability, 59%. That's definitely great. I'm going to do the same story, load UPS, and I just want to make sure the expiration date I used to buy, okay, I'm looking for an arbitrage opportunity, if you think about it. Okay, that's what I'm really doing. I know the expiration date where earnings are priced are happening will tend to increase its value. Okay, will tend to increase its value, and what I'm doing is I want to buy the options before they increase the value, because it's almost a sure thing that as earnings approach, the value of those options will grow based on the perceived risk and opportunity of earnings, and the intense buying and selling of options around that date, right? So I want to buy that option because it's gonna gain value, but I want to buy it before it gains value. That's why I'm calling it an arbitrage opportunity, because then I'm going to have a differential with the shorter expiration date, okay, which is going to be pricier, and the longer expiration date, which hopefully is going to be cheaper. Okay, that's that, because that number, assuming is that date, I don't remember by heart, but assuming is that date, that number will go up. So I'm looking for that arbitrage opportunity. Okay, I'm not sure is the case. I believe it may be the next one. So earnings are on the 27, so it's not the 23. So it's going to be the next one, which is the 30th of April, and that one unfortunately does not allow me to do the arbitrage, play that I want to execute, because notice how we already got extra pricing built in, actually 6% more or 5% more than the prior one. Okay, so notice how the next one is 27. So again, maybe if I had 27 and on the front I can do 27, so I'll take it. But now I'm going to be paying more for the one I buy and selling the one I sell for less. Okay, and I don't want to do that. So I'm just going to keep going through the list. And again, What's the issue? Well, the issue probably is that the date I'm picking, the stock I'm picking happens to have an earnings date, which may be just a bit too close, or maybe just is triggering too much interest. And of course, UPS is obviously a well-known company, and again, certainly there is interest, isn't it? HLT. Oh, I have a question here from DM series. Seeing this as an obvious question come to my mind, which company provide you the fund to trade using options, and what are their general terms and eligibility? Well, actually, DM, I utilize my own funds to trading, as well as our community of traders, at least the ones that have taken our courses and use our apps. They utilize their own funds. Having said that, there is a collection of companies out there, including private firms that allow traders to trade funds or work in a context of a group of traders and things like that. And there are plenty of companies out there that, as long as you could show good performance, some track records, and so on, they will be delighted to have some money available for you guys to trade. So that the goal is that you guys create some track records, some statements, okay, with real accounts, with real capital, even if it's little bit of capital only, but real statements with real accounts. And as long as you can show some performance, it should be fairly simple to identify those companies that allow you to trade using their capital instead of your capital. Okay, but again, this is not a service that we provide. I guess I understood your question correctly. If I misunderstood your question, feel free to retype it, and I'll be happy to give you a different answer. But I believe that was your question. So HLT 47.5%. It's almost 48, but it's not. So I'm going to check pre and post market, and we got 45, which is not good enough. So I'm going to look at Medtronics. 42% with pre-post market, that's not good. Regular session is 56%, that is indeed good. Are we making all times high? Yes, indeed. So no red UFOs. So we go for the next one. RCL. So RCL has multiple UFOs above and below. Probability may be good, 53%. I'm just going to wait for the PD to go away to have the real figure. 52%. Here we go. What if we look at pre and post market? We have 47, so that's not good enough. Okay, but the one with regular session data, it's definitely valid with the 52%. Okay, earnings in this case are happening on May 19. So we have now, let's call it 2 months of time. So we should be able, I would say we should be able in this case, RCL, we should be able to find a better differential between what the options cost and what you could sell them for. So 21 of May, I believe that was the one. Let me double check. 19 of May, yeah. So 21st of May, it's the expiration date that lines up with earnings. And notice how we got 64%, where everything before happens to be 59 or 61. So again, in this case, if you think about it, is like from 61 to 64 is like 3% differential. Okay, so 3% differential on a 60% implied volatility, which is a very, very large number. I mean, it's not like it's weird since 2020 with the excess of volatility in the markets, but certainly compared to the prior stock, it's very large, isn't it? So again, let's say you had 0 trades available, so I may go ahead and explore if this trade is valid, because 3% out of 60%, it's almost like, it would be fair for me to say that the options you're going to buy and the options you're going to sell, it's kind of like the same price from an implied volatility point of view. Okay, I mean, ideally that number would be, again, that 59 or maybe that 60. So you buy 60, you sell 61, even better. But again, a 3% differential doesn't scare me, because we got 64% implied volatility. So I'm okay. What does bother me though is the spread, okay, of those options. It's just too wide. Okay, it's just a bit too wide. Yeah, the front week, it's the next week is okay, but definitely May 21st. Yeah, not the best. Okay, so what I'm gonna do is just keep going. Philip Morris is there, so we'll leave that one alone. We have Coca-Cola, okay, and we'll explore what's gonna happen with Coca-Cola. Hopefully, we'll find a trade in this case. Okay. DM, you got a point. Very good. DM, but then whom to look up to if you want to get into professional trading and make it your career, primary source of income? Do you have links of those companies who give you capital? Well, actually, I don't maintain a list of those links, but I mean, first of all, I would say feel free to email me and I could take a look and send you a couple of links. No, not an issue. But I would just go ahead and recommend you to just Google it, okay, and you will find those companies. Okay, you will find those companies. There are multiple companies, and you can also maybe one good um, term to Google, which for whatever reason I always have difficulties to pronounce that word in English language. So you guys may laugh. That's okay. It's proprietary trading firms. Okay, so that first word is the one I struggle to pronounce. I don't know why it's difficult for me to say proprietary. I'm not sure if I said it 100% right or not. But anyway, if you Google proprietary trading firm, those are typically firms that are looking to hire traders and give them funds on at their disposal, while those traders may be trading from their office or trade from home remotely. And normally they would put you in a process where you need to prove yourself first. First of all, show your statements and your results, then prove yourself trading their paper money accounts. Okay, and when they see that you could do that well, then they will give you access to some funds and extremely rigid risk management rules that if you ever violate, they would basically cut the access to the account for you. Okay, so again, it's a very nice place where to be, especially if you are conservative when it comes to not using your funds, or maybe you have limited funds, or maybe you plan to trade very large funds in the future, but you want to be prepared and you want to assume that risk and experience with other people money. So again, all of those are possibilities. Okay. Yeah, they don't lend you capital. They just allow you to trade their money, and of course, it's a profit sharing type of scenario in most of the cases. Yeah, yeah. They will also probably charge you fees to be able to have access to the trading platform. Probably they will put you into some process where they're gonna coach you, they're gonna monitor you. Again, that's really common practice. So again, I would suggest that you Google. I'll say one more time: proprietary trading firms. And if you have any question as you do that, I'm more than happy to, if you want to shoot me an email and discuss that with you in an email, definitely, no, not an issue. Okay. Okay, so we are looking at Coca-Cola. Okay, it's for 52%. With pre-post market, we are talking about 48%. So actually, I could use both pre-post market as well as regular session data. Earnings are happening on 420. Okay, and one of the things about Coca-Cola, even though right here it's the complete opposite of what I'm about to say. Okay, what a move on Coca-Cola. So what I was going to say is that most of the times Coca-Cola is that very, very, very boring stock. So what does it mean that a stock is boring? Okay, which again, you can see this move. This is not a joke. Okay, but normally, what does it mean? Well, when you look at implied volatility, okay, and again, putting on the side this anomaly, look at what normally happens. Let me load more data. So I'm gonna load, let's say 10 years of data. So if I move back in time, like from 2015 to like 2020, so that's like 5 years of data more or less. That is, the top of volatility is 24. Okay, the bottom is like 10. Okay, but if you look at, let's call it the mean. Okay, so it's about like 15%, right? And it stays there all the time. Okay, even when this company is reporting earnings, right? So prior to earnings, typically you find an increase of volatility, not so much. In this case, prior to earnings, you find a little bit of an increase of volatility. In this case, just tiny bit. Just prior to earnings, typically you find an increase of volatility, and really you didn't have an increase of volatility. What you had is a drop after earnings, but it was already up there. So again, long story short, Coca-Cola tends to be a company that most of the time, putting on the side the anomalies of 2020 and COVID and everything else, this company, very similar to companies such as T-Mobile, AT&T, utility companies in general, things like that, is what I would define as a boring company. Okay, a boring company, and therefore, while we have it on the scanner, and we could go ahead and plan on another directional trade, I'm just going to suggest we pass, because the likelihood of having a fair increase in implied volatility, which is what really is going to help the calendar spread to pay, the likelihood is not that great. So I'm just gonna pass, even though if you were to do it, it's not wrong. It's just that the majority of the trades that you would expect on a stock like Coca-Cola or again AT&T, and so on, would be a bit disappointing from a from a spiciness point of view. Okay, we may not get too much spice kicking. Okay, so I'm just gonna pass and go for the next one, or the last one in the list, which is AFL. Okay, and we're gonna be looking at this one. And by the way, I want to rerun the scan as well. I'm gonna rerun it with, instead of bottom, I'm gonna look at top. Okay, so that way we'll have some opportunities as well ready for later. So with pre and post market data, we got 43%, which is not good enough. If I move to regular session, that 43% becomes 55%, and that is good enough for us to look at planning a trade. When looking at the monthly time frame, though, I believe, on that was July 19. Okay, July 19 is when we made all-time high. So right now it looks like there is no red UFO above price. Just to make sure if that's the case or not, I'm just gonna load June 19. Okay, and now I'm gonna be able, once that information is loaded on the chart, I'm going to be able to scroll back up. Here we go, and now notice how at least one UFO is being uncovered. So we still got pending data. So I want to make sure, yes, we do have multiple UFOs and they have a good probability. Okay, so we do have a decent setup to go ahead and plan on a non-directional trade on AFL. So that's good. Now, earnings on April 28th. Okay, earnings are on April 28th, and therefore we're going to do the same exercise that we have done with the other stocks, which is to hopefully find that little arbitrage opportunity that is going to help the trade to do a bit better. Okay, so this is AFL. Again, earnings are on the 28th of April. So 28th of April would bring us to 30th of April. And what do we have? Here we go. We have what we're looking for. Okay, we have what we're looking for. Notice how the implied volatility on that date has not started increasing intensively yet. Noting that even the following expiration dates got more implied volatility. Okay, so it started because the prior one is 23, but it didn't start that much. Okay, and most importantly, if I sell 25 and I buy, if I buy 25 and I sell 24.5, so it's kind of 25, right? So it's kind of like, I mean, in a perfect world, you would be buying, 20 and then you would be selling 25. That would be perfect. But between us, that's almost impossible to find. Sometimes it will happen, but it's one of those very unique opportunities. So I'm happy enough with what we have in the screen right now. You can see that I would be basically buying the options and selling the options at the same price when it comes to implied volatility, knowing that April 30 expiration will enjoy an increase of volatility as we are traveling towards the earnings date, which is a month and a half from now. So I'm going to plan a trade on AFL. Looking good so far. I'm just going to have a sip of water if you guys don't mind, and we'll plan the trade. Here we go. So AFL. So what are we going to do? Okay, so here's the current price, 51.58. Okay, this is where we're at. So the first thing I'm gonna do is I'm just gonna make this line to be dotted line. I'm gonna pick using April 30 any of the strikes and right click, and I'm just gonna, I could do anything here. I'm just gonna analyze and buy, just a single option. It didn't go through. Analyze and buy a single option. Here we go. Now it did. Why? Because the only thing I'm doing right now, it's just bringing any option into my analysis tab. It doesn't matter the strike. The only thing that matters so far is the expiration date I have selected. Okay. Because that's going to give me a projection of where price should go based on probabilities, which is one standard deviation of price movement going from 56 to 47. So knowing that, I'm just going to move this to 56, more or less there. Okay, good enough. And we also have, we said 47, somewhere here. You will say that 47.18. Okay, good enough. So this is the statistical range that we are dealing with. Okay, and if I was to, again, in a perfect world, you start exactly in the midpoint. Doesn't have to be like that. Okay, to be exactly in the midpoint. Okay, so this is the distance from the upper part. If I look at the distance on the bottom part, I am surpassing a little bit that range. Okay, so it's not super precisely perfectly ideal, but it's okay. Okay, it's okay. It's the excess that we can see here is not that much. Okay, it would be worse if I was to point at this UFO. Okay, and if I was to measure the distance from current price to there and I was to project it above, so you can see now the excess above the red UFO is much more. Okay, so it seems fair enough that when planning on my non-directional trade, and I'm not sure if you recall, but when we talked about this in the last session, we said that we are going to be using those UFOs in order to, number one, define the range. But really, in this case, okay, it's not an iron condor. Okay, it's not an iron condor where I'm going to sell options above and sell options below, and therefore the range is basically, the place where I stay alive. Okay, it's not the case. In this case, I'm defining the range so I can calculate what's the midpoint of the range, because this is the midpoint of the range. That's where I'm going to buy a call and sell a call, or buy a put and sell a put. Okay, now to identify the midpoint, I need to define the range. Okay, and that's why I'm using the UFOs in that sense, in order to be as realistic as possible. So if I look at the top UFO, which is 56.49, right, and the bottom UFO, which is 47.26, take that value divided by 2, 51.87, that's the midpoint. That sounds to me like it's 52. Okay, so when looking at the option chain, what do we have? Well, we have 51. Just get, we got 51.87. So that value, because of the decimal places, is closer to 52 than closer to 51. So what type of trade are we building here today? We are building a calendar spread that will be made of either buy the 52 call and sell the 52 call using two different expiration dates, to be discussed in a minute, or buy the 52 put. Okay, which this, in order for me to confirm which one is going to be the put version or the call version, what I would need to do basically is to go ahead and simulate those two trades to find out. In the books, in the theory of options trading, both of those strategies will be the same. But then the reality is that the way options are priced in the real world, beyond the Black-Scholes model, implies differences, which sometimes are substantial and sometimes are even difficult to understand or explain. But if that's the price you get on the option chain, that's what you get when you trade it. Is that making sense? And therefore, the ultimate test is going to be to try it out on the simulation tab of your analytic tool. Okay, so I'm going to work on the call side to put the trade together. And when I'm done with the call side, I'll then go ahead and look at the put side, and then we'll identify what's best. Okay, so buy a call, sell a call. That's what I'm going to do now. Of course, to buy the call, we're going to use April 30. Why? Because that's where the earnings are going to happen, and this is where we're going to enjoy that increase of implied volatility. Okay, so April 30, that's a given. Okay, so analyze and buy. It doesn't allow me to do a calendar here. Why is that? Right click, analyze and buy calendar. Okay, so I guess I'm picking strikes that don't exist on the front week. So what if I use the 50? The 50 should be available everywhere. Oh, interesting. It's not allowing me to do it. Okay, so I'm just going to use a shorter expiration date. See if at least I'm allowed to enter the trade. Yes, calendar. Okay, and then I will adjust it on the analysis tab. Okay, so what do I have here? I have 52 call. Okay, so you can see strike 52, type is calls. Okay, one is buy, one is sell. Okay, and now what is totally wrong is the expiration dates. Okay, so let's begin with the one you buy. Okay, the one you buy, we said it's going to be April 30. Again, one more time because of the earnings. So let's change that to April 30. Here we go. And the one we sell is going to be what? Well, the one we sell, okay, in a perfect world, we're going to use March 19. Okay, we're going to use March 19. And then we will move to March 26. Okay, and then we will move to April 1st. Okay, but having said that, and hopefully this makes sense, I'm not going to use March 19. Why is that? Well, because I have oh, wait a minute. Yeah, I just got confused for a minute. Yes, we will be using March 19. There is more implied volatility built in, so that's actually a good one. So yeah, so let's do this. So we're going to use March 19, which will probably roll and change this trade, I would say tomorrow, very, very likely. Okay. Also notice that we have much more premium on the put side, so probably we're going to do the put side. But let's do it one step at a time. So by April 30th, sell March 19. Okay, that's the trade we're going to do. If I do this with the calls, it's looking like, if I'm right, I'm gonna hit that peak of profitability, which is gonna pay me $43. Okay. If I'm wrong, notice that I'm gonna be losing 120 over. So you may be thinking, wow, this trade is really not good. Okay. Well, let me go back to this like I did last week, and I will explain that a bit better. But before I do it, let's compare the call side with the put side to see which one is more convenient. So notice that the only difference between this and this is that above is calls and below is puts. Okay, so if I uncheck the call and I leave the puts only, so the top of profitability, it's about $40, and with the call, with a loss, it's about almost 140. So almost 140 against $40, and here is almost 140 against $42. So it's kind of the same, guys. Okay, in this case, to be honest, the difference is very, very little, and one of the reasons why is because, you know, March 19, it's very, very short. Probably, I would guess, there is no dividend payment until at least after March 19, and therefore the premium built in the puts, it's very similar to the premium built in the calls. So what I'm going to do is the following. I'm just going to use the put side, because if you think about the calls, okay, if I sell something for anywhere between 15 and 20, and let's say I get filled at 20, it doesn't meet one of the key rules that we have, which is we never sell options for less than 35, isn't it? So then in this case, I am going to be forced to use the put side, which, even though the word forced is not necessarily a good word, in this case, to be honest, it's not a problem at all, because, you know, as we saw with the risk profile, they are basically equivalent. Okay, it's not a big difference at all. So we're going to do this trade, okay, using the 52 put, using April 30, we buy that one, and the 52 put using March 19, we sell that one. But guess what's going to happen? Okay, tomorrow and the day after, you know, that's when that put expires. So before this put expires, we're going to have to talk about it. We'll do it tomorrow. We're going to have to roll this put, and instead of March 19, use the next expiration date and sell another put, okay? And ideally, the stock would move, a little higher or something like that. So those 60 over cents we may get will be kept as ours, and then we're going to turn around and sell the next expiration date, which is going to be another, let's call it 80 cents, another, let's say $1 to collect, and again, lower the risk of the trade. And when you do that, basically what happens is that this risk profile is going to expand, right? So it's like if I tell you that instead of paying 35 cents, let's say I collect $1, right? So that means that I'm going to pay 35 cents instead of $1.35, right? So what just happened to this range? Well, now my net profit instead of $42 is going to be $1.42, okay? And now, as long as the stock remains above 47 and below 56 or 57, which by the way, it's kind of like our range. So now that's it. You're going to be in profit no matter what, isn't it? Which is the range we want to trade, okay? So again, this is looking good, okay? So what I'm going to do, and we are basically reaching the top of the hour. So again, I'm using lots of the time in these initial sessions to go over the trades and so on. The normal process on how we run those sessions, it's to, again, have shorter duration sessions in YouTube, Facebook, and so on, and have the longer duration sessions in the private rooms. But again, I want to make sure everybody follows, okay? So at least we have, the process out there for everyone. So everyone is supported. And then again, we'll work on this model that I discussed before, where the part-time traders, you have shorter duration sessions. And, the ones of you who are the super traders, the super passionate, the guys that you never got enough, you always want more. So you have the longer duration sessions in our private room, okay? So one step at a time, guys, just getting adapted to work together. So we have FAL, okay? So loading again. We're going to be using April 30 and March 19. Okay, so analyze and buy a trade. It's going to be a calendar. And again, I'm going to be buying the 30th of April with the puts, selling the 19th of March, and it's going to be the 52. Okay, so this is the trade I am about to execute. I'll give 1 second in case you guys want to take a screenshot or something. But that's the trade. Thank you so much, Ahmed. This means a lot. You just made my day, my friend. I mean, I think we all share the same passion, isn't it? We will not be together here as we are. So it's really a pleasure for me. So anyway, I'm gonna go for it. So right click to confirm and send this trade. Okay, and I'm just gonna go for it, send. So the trade is now right here waiting to get filled in this case. Just be patient until you get filled, okay? And if you don't get filled, you can always change the price just a little bit. Maybe you want to pay another 5 cents extra, something like that, until you get filled. And now you are in the trade, and now let's have the market do its thing, okay? Because it's gonna do it anyway. So let's go with the flow. Anyway, so I guess I will be filled in just a moment. We got 125 to 150, midpoint is 138. The order I placed here was 135, if I'm not mistaken, correct? 135. So it's actually, yeah, a bit too optimistic. So let me do this. I'm just gonna go ahead and be willing to pay a bit more. I'm gonna make it 140. Confirm and send. Okay, let me see. That's it. I just got filled. Okay, so I got filled at 140. Again, as you can see here on the upper left, it says simulated trading. So this is not real-time market conditions. This is simulated conditions. Even though, based on experience, I would say that 140 is something that should be possible. Look at that. Maca just got filled at 135. Very good price, Maca. Well done. I got 140. So that's it. We're in. Okay. Cool. My friends, time to conclude the session. Again, a pleasure as always to be working with you, guys. Keep up the good work. Makes me really proud when I read your emails. I see your progress. If you have questions, if you are in learning stages, if you are struggling, you need support, you have, you're stuck, whatever, make sure you email us, DM if you want to discuss more about the fonts and all of these things that you were commenting. My email address is jose@traddictiv.com. Definitely delighted to maybe give you a bit more guidance on that via email. Keep in mind, I'm not an expert of that because, as I said, I trade my own funds. And while I did explore the world of that type of firms many years ago when I started, and I know how they work. It's not like I have the most updated information available, okay? Because again, it's not what I do anymore since many years ago. But certainly,